What if I told you the biggest financial scandal in history didn't look like a crime at all? No masked hackers? No dramatic bank robberies? No secret offshore accounts discovered by accident? Instead, it looked like stability. It looked like prestige. It looked like genius. For decades, billionaires trusted him. Banks trusted him. Universities trusted him. Even regulators trusted him. And yet, behind that image was a machine designed to do one thing: take money from the present to pay off the past until reality ran out. This is the story of Bernie Madoff and the largest Ponzi scheme ever uncovered. But this isn't just about one man. It's about why intelligent people, powerful institutions, and entire systems failed repeatedly. And the uncomfortable truth is this: the conditions that created this scandal are not gone. They've evolved. The man who became the market. To understand how this became the biggest financial scandal in history, you need to understand who Bernie Madoff was before the collapse. Madoff wasn't an outsider. He wasn't some shady backroom operator. He was Wall Street. He founded Bernard L. Madoff Investment Securities in 1960. He helped pioneer electronic trading, served as chairman of NASDAQ. He was respected, connected, and embedded at the highest levels of finance. His reputation was so strong that it replaced due diligence. That's the first critical mechanism in this story. Trust became a substitute for verification. His investment strategy was marketed as sophisticated but stable. He claimed to use a split-strike conversion strategy involving blue-chip stocks and options. It sounded complex, sounded safe. Most importantly, it delivered steady returns, around 10% to 12% per year. Not explosive, not outrageous, it's just consistent. And that consistency was the hook. Because markets don't behave consistently. Yet Madoff's returns barely fluctuated through crashes, recessions, booms, and volatility spikes. That should have been the red flag. Instead, it became the selling point. A simple lie that grew too large at its core. Madoff's operation was shockingly simple. There were no real trades. Investor money wasn't being invested in markets. It was being deposited into a bank account. When older investors wanted withdrawals, he used money from new investors to pay them. That's it. A classic Ponzi scheme. But here's where scale changes everything. Most Ponzi schemes collapse quickly because they attract scrutiny. Madoff's didn't because he wasn't chasing random retail investors. He targeted wealthy individuals, hedge funds, private banks, charitable foundations, international investors. Entire feeder funds were created solely to channel money into Madoff's firm. These intermediaries collected fees while performing little to no real verification. And this is where the cause and effect chain starts accelerating. Reputation created trust. Trust eliminated scrutiny. Lack of scrutiny enabled growth. Growth increased prestige. Prestige attracted even more capital. By the early 2000s, billions were flowing in. Harry Markopolos, a financial analyst, repeatedly warned the SEC that Madoff's returns were mathematically impossible. He submitted detailed analyses showing inconsistencies. The SEC investigated multiple times, and each time they failed to uncover the fraud. Why? Because the fraud was hidden in plain sight, and because regulators lacked both urgency and technical expertise. Bureaucratic complacency met institutional arrogance. That combination allowed the scheme to scale to an unprecedented level. The rise. When the system becomes the shield at its peak, Madoff's firm managed what investors believed to be over $60 billion in assets. The real cash losses were around $17 to $20 billion. The rest were fictitious paper profits, numbers on statements that never existed. But here is what makes this the biggest financial scandal in history. It was on just about the amount. It was about the ecosystem. Entire European banks funneled money to him. Major institutions performed minimal audits. Auditing was handled by a tiny, unknown accounting firm. Custody and execution were internal, no independent oversight. Every layer of financial governance that should have stopped this failed. And during Market.com, no one wanted to look too closely, because everyone was making money. This is the uncomfortable economic truth. Fraud thrives in environments where incentives discourage skepticism. As long as withdrawals were manageable and markets were stable, the scheme survived. But Ponzi schemes don't fail because of investigation. They fail because of liquidity. The breaking point. 2008, the global financial crisis was the stress test that exposed the lie. In 2008, markets crashed. Investors panicked. They demanded their money back. Madoff suddenly faced billions in redemption requests, but there was no portfolio to liquidate. There was no reserve of assets. There was only a bank account funded by new deposits, and new deposits had stopped. The machine required constant inflows. The crisis froze those inflows overnight. On December 10, 2008, Madoff confessed to his sons that the investment advisory business was one big lie. The next day, he was arrested. And just like that, decades of illusion collapsed in 24 hours. The consequences were devastating. Thousands of investors lost life savings. Charitable foundations shut down. Retirement accounts were wiped out. Some victims committed suicide. This wasn't just a financial loss. It was a psychological collapse of trust. Major banks paid billions in settlements for enabling the scheme. The SEC faced public humiliation. New regulations were introduced. Oversight was tightened. Madoff was sentenced to 150 years in prison. On paper, justice was served. But the deeper issue wasn't one man. It was structural. After Madoff, reforms were introduced under the Dodd-Frank Act. Compliance standards increased. Transparency rules expanded. Yet financial scandals didn't stop. The 1MDB scandal siphoned billions through international banking channels. Wirecard fabricated billions in cash. FTX collapsed after commingling customer funds. The details change. The mechanisms rhyme. Each time the pattern repeats. Charismatic leadership or elite reputation. Complex or opaque financial structures. Returns that seem stable or extraordinary. Weak oversight due to trust or incompetence. Technology evolves. Incentives don't. Today, trillions move through shadow banking systems, private equity structures, offshore vehicles, and crypto exchanges. The opacity is often higher than in Madoff's era. And here's the hard truth. Regulation reacts. It does not anticipate. Financial innovation moves faster than enforcement. Always. Global debt now exceeds $300 trillion. Derivatives exposure globally runs into the hundreds of trillions. Private markets manage trillions with limited transparency compared to public markets. These aren't Ponzi schemes. But the scale of opacity is massive. Incentives still reward short-term returns over structural integrity, and retail investors increasingly chase high-yield products without fully understanding risk mechanics. The same psychological triggers that fueled Madoff's rise, greed, trust in authority, fear of missing out, remain unchanged. What changes is the packaging. In 2008, it was steady 10% returns from a respected Wall Street insider. Today, it might be algorithmic yield farming, leveraged real estate syndications, or opaque structured products. Different labels, same vulnerabilities. 3 clear takeaways. Consistency as suspicious markets fluctuate. If returns are stable in volatile conditions, demand transparency. Smooth performance in a chaotic environment is often manufactured. If you don't understand how returns are generated, you don't understand the risk. Reputation is not risk management, Madoff chaired Nasdaq. That didn't prevent fraud. Authority and prestige create cognitive bias. Verification must be independent of status. Trust is not a control mechanism. The collapse happened in days. Financial systems absorb stress quietly until liquidity disappears. Then collapse accelerates violently. By the time panic is visible, it's too late. The biggest financial scandal in history wasn't powered by genius mathematics. It was powered by complacency. And complacency always returns during periods of stability. The next scandal won't look identical. It never does. But it will share the same DNA, opaque structures, incentive distortions, overconfidence in institutions, a public that prefers reassurance over skepticism. The question isn't whether another massive scandal will occur. It's where, and whether you'll recognize the warning signs early enough. If you want to understand how financial systems really work, not the polished version, but the structural mechanics beneath them, subscribe and turn on notifications. Because history doesn't repeat word for word, but in finance, it rhymes with ruthless precision.